Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. My two co-hosts, Mark Hump and Nam Phan, are off today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given during away this show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. We do have a special guest today, Chris Miles. From where are you from, Chris?
Utah.
All right. From Money Ripples. And we're going to find out what that's all about. I'm going to read a quick little bio. Before I do, though, this episode is going to be called Why You Need Passive Income. So here's Chris's bio. He's cash flow expert and anti-financial advisor. We'll get into that in just a minute. Is a leading authority teaching entrepreneurs and professionals how to get their money working for them today. He's an author, podcast host of the Money Ripples podcast, has been featured in U.S. News, CNN, Entrepreneurs on Fire, Bigger Pockets, and has a proven reputation with his company, Money Ripples, getting his clients fast financial results. In fact, his personal clients have increased their cash flow by $300 million in the last 13 years. Chris, welcome to The Best of Investing.
Hey, I'm excited to be here, Edward.
Okay. So first of all, I got to ask you, why are you called the anti-financial advisor?
Because I think financial advisors suck. No, I'm just kidding.
Well, no, you know what's funny?
No.
It's not back in I'm going to say 1979, there was I think it was Financial Money Magazine, Financial Advisor, something like that, magazine, or Newsweek, some big Time Magazine. That's what it was. It was Time Magazine, and on the front was a monkey with chalk going to a chalkboard with a suit on, doing all kinds of calculations or something. And the heading was on the cover was "Today Everyone's a certified financial planner, financial advisor." And finally, they came up with the certified financial planning designation. But so I can't necessarily disagree with you, or at least Time Magazine didn't disagree with you 40-something years ago.
That's right. It's timeless.
Yeah. So
I mean,
go ahead.
So kind of get back to anti-financial advisor. I mean, again, I know most financial advisors have very good hearts. They're well-intentioned. Yeah. And I used to be one of them over 20 years ago. But here's what I learned is that, when you talk about mutual funds, which really that's all they do, they really are just paid to sell you products. They pay to really sell you mutual funds or insurances. That's it. And it's a variety of different ones. It's kind of like Mexican food. You know how when you look at a taco and the ingredients inside of a taco, if you just take the taco and fold it in a soft shell, it becomes a burrito, right? And then if you put a little bit of cheese on top, all of a sudden you're like, oh, look, it's in a little sauce. You're like, oh, it's an enchilada.
Yeah.
It's the same ingredients, just packaged differently, right? It's the same thing. That's really what I realized is I was a salesman in a suit as a financial advisor. And I didn't start the industry that way. I mean, I had parents that taught me good values, but never taught me much about money, other than it was scarce, right? We can't afford this. Money doesn't grow on trees. We think I am made of money, Those are the kind of things I was raised on. So when I went to college, my plan was to become a business consultant, but I figured I should have real life business experience. So I started looking for some business to start. And the one that kind of came up with that was intriguing was becoming a financial advisor, not knowing, like kind of your point earlier, that they take anybody off the street that can pass a test with 70% and doesn't have a criminal record.
Yeah.
And that's how I got hired as a financial advisor. Did that for several years. And then several years in, my dad, he said, hey, when are you going to advise me? And so I sat down with him. This is a little after Y2K.
Yeah.
And he said, I'm 61 years old. I want to retire. And so he opened up his books, his finances. For the first time in my entire life, I got to see his finances. And this guy was the penny pinching saver. I mean, cheapskate to the T.
No,
and
frugal. We like to use the word
He would say frugal.
Yeah.
He would say frugal. We would all say cheap. I mean, very cheap. And so you look up cheap, and he's in the dictionary, right?
Gotcha. Okay.
And he even stuffed money in his 401k at work, and he paid off his debt. He paid off his house early in 18 years. He was so proud of that. Yeah. And I'm looking at his finances, and I said, Dad, here's the deal. If you want to retire today, you better hope you die in 5 years, because that's how long it'll take before your money runs out at your current lifestyle. And his lifestyle wasn't, again, he was cheap, but even just based on lifestyle with inflation, everything else, that was it. And he said, well, okay, well, what else can I do? And I said, I don't know. You did everything right.
Okay.
And so that bugged me to the point where eventually when the students ready to teach their peers, one of the guys I trained to be a financial advisor went to do real estate investing. He ended up showing me there's a whole nother alternative investment path you could do that could actually create financial freedom now.
Okay.
To the point where I quit being a financial advisor and then ended up later that year becoming financially independent and retiring myself when I was 28 years old.
All right. So we're teasing the audience with that. We're going to come back and get more into detail. Here's our first trivia question. And again, Chris, if you know the answer, don't say anything yet. Here's our first trivia question. Which Spice Girl was the only one named after a spice? Call 888-912-1190. First caller with the correct answer wins that tanning certificate, which, by the way, is worth over $100. So again, here's our trivia question. Which Spice Girl was the only one named after a spice? And before we cut to break, I do let's go to break now. When we come back, we'll answer the trivia question and then make a quick mention here. Don't touch that dial. The Best of Investing. I'll be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my special guest, Chris Mills of Money Ripples. That's kind of a neat, I'll have to get into that with you for a minute after we answer the trivia question here. Okay, so first trivia question, which Spice Girl was the only one named after a spice?
Of course you would ask me that because I'm not a Spice Girl fan.
Either am I. Don't know anything about them.
I'm gonna randomly just say Ginger Spice.
Ginger, that is correct.
Is it really?
It is Ginger, yeah. Now, I want to make a mention here for the Mount View Hotel and Spa. They're offering 15% off this summer. It's only $395 a night for weekends, $295 a night during the weekdays. And this, I believe it's going to expire sometime in September. So you want to get to the Mount View Hotel and Spa in Calistoga. If you've never been there before, you got to check them out. One of the nicest pools, totally warm. You get all that Calistoga water. It's awesome. Check them out, the Mount View Hotel and Spa in Calistoga. All right. So Chris, you were talking about our first question was, why are you called the anti-financial advisor? So you're telling the story about how your dad, you said, hey, Dad, if you want to retire, well, if you only live 5 more years, basically your money won't run out. How much was he working with at the time?
At the time, he got hit by Y2K pretty hard, especially with the tech sector tanking, if you recall. So he had roughly about $250,000 at that point.
I can see why you said no matter what your lifestyle was, 5 years and it's quite
$50,000 a year. That's it.
Yeah. Oh my gosh. Even if you earn an income off of that, it's probably not still enough to do it. So, how did you advise him? What would you say?
I didn't have an answer. I really didn't, because I remember thinking like, well, maybe there's these type of products I could do, or this type. And I even said, I'm like, well, really the only asset you have beyond your cash is your house equity. Yeah. It's like, well, should I invest that? I said, well, no, because I can't guarantee the market's going to go up or down. Even if I get these indexed type of things where there's some safeguards, it may not be enough to make up for the interest on the mortgage. Exactly. So I just told them, I say, I don't have anything for you. And that's why I kind of, over the next coming weeks, that's why I end up talking with my friend Doug, who I'd hired to be a financial advisor and then quit to be a real estate investor. He was the one that really brought it up with me. He said, how many of your clients are truly financially free where they don't worry about money? I said, well, none. They all worry about money. They all worry about running out at some point. Sure. Heck, I even just saw a new study came out, 35% of 401k millionaires, people that have over $1 million in their 401k, 35% believe it will be, quote, a miracle if they can retire, unquote. Wow. I mean, think about it. I mean, the average 401k balance is actually less than $100,000. But for somebody to say $1 million plus, it'll be a miracle because I'm trying to pull off 3% a year off this thing. That's 30,000 a year if I have $1 million. And that's the problem. That's the real problem with financial advising, is that they've never come up with a good solution to break free of that.
So you met this guy, Doug, or your friend Doug, and what did that shift you into?
Well, it shifted me more into focusing on what you hear about in Rich Dad, Poor Dad, right? Which is a book I read as a financial advisor, thinking that somehow Rich Dad, Poor Dad, Robert Kiyosaki was saying financial advisors were great, which he doesn't say. Mm-hmm. But it was all about cash flow, passive income, right? It's not about how much you have in assets, because in financial advising, they teach you the accumulation theory, right? Which is you accumulate a lot of money, then you live on 3%. Now, there's still some people out there like the dinosaurs telling the 4% rule, which has already been disproven by even like Morningstar years ago. Even 20 years ago, when I was a financial advisor, we're saying, is 4% too high? And so now they're saying 3%.
Well, it
So
really, tell me if I'm wrong, but I mean, I guess what I would look at when I hear that is what is your lifestyle? How much money do you need? B, obviously how much you're working with. Big question, how much are you earning off of that? Because if you're earning, let's say 4% and you're only drawing 3%, you'll never run out of money. In theory.
Well, as long as inflation doesn't go up, right?
Correct. That's right. That's right. So those to me would be the key components. And for a long time, conservative investments were only paying 1 or 2%.
And that's the problem. The returns have come down for conservative investments like bonds, treasuries, things like that. And at the same time, inflation is actually, let's be honest, we know inflation's higher than what the government says because they don't have to raise Social Security up.
At least 15%. Seriously.
Oh, yeah.
I mean, in some cases, it's probably maybe more like 25 to 30%.
Yeah. I mean, if you check shadowstats.com, right? I mean, they talk about the real inflation rate, what it used to be in the 70s, and then they altered it along the way.
Yeah.
They'll say that's about 7% higher than whatever they report. So if they report 2%, it's really 9%. If they say 9%, like last year, it's really closer to about, really 16, 17 plus percent, right?
Exactly.
You're absolutely right. And that's why people are losing. That's why it's funny that the consumer, the saver, gets blamed for not saving enough. But they were saving money just like my dad was, just like they were taught. They might have been saving that 10%, that we used to teach back in the day.
Sure.
And now you're hearing people say, oh, no, it's 20%. You should be saving 20%. Now, the truth is, what I find, even people that get 401ks with a match, whatever you save per year. So if you max fund your 401k at $20,000 a year, at retirement, that's about the lifestyle you'll live on, just given a 5% inflation rate, just being conservative, right? 5% inflation, you're going to be living on $20,000 a year lifestyle.
Well, the other thing you mentioned though is like, going savings from 10% to 20%. And well, the good part is taxes have gone down, right? Oh, no, they haven't. So now how are you supposed to live on that 80%? You can't, because you're paying so much in taxes, and just everything else out there. I mean, it's ridiculous. There's almost no way you can save 20%. Unless for some reason you make $1 million a year and you only spend $100,000 a year, then for sure you can do that. Tell you what, believe it or not, we got to cut to another break. I know it goes very, very fast. We got a bunch of questions here for you. All right. Second trivia question. U2's Paul Hewson is better known by which nickname? Call 888-912-1190. First caller with the correct answer wins that tanning certificate from Tanbella Tanning Salon. Again, U2's Paul Hewson is better known by which nickname? All right, stay with us. Don't go anywhere. The Best of Investing will be right back. Welcome back to the Best of Investing. One more time. I'm Edward Brown, your host, along with my special guest, Chris Mills. Second trivia question. U2's, the band U2, excuse me, Paul Hewson is better known by which nickname?
I'm going to guess Bono.
Yeah, that's the only one I know from U2.
It's the only one I know.
Want to make one other quick mention here for Transcendence Theater. Go to bestnightever.org. They got some awesome productions coming up. And some of them are actually outdoor productions. I went to one last month and it was phenomenal. It's almost like going to a Broadway show out underneath the stars. Beautiful. Check that out, bestnightever.org. All right, so Chris Mills from Money Ripples. Okay, how did you get that? How did you come up with Money Ripples?
It actually came up. I was working in another partnership after the recession or during that time and then coming out of the recession. And we already started to help people free up cash flow. I stopped teaching about passive income because kind of a part two to my story of becoming financially independent and retired at 28. I came out of retirement in 2007 to teach people how to do what I did. And then the recession hit. And the funny thing is all the people we were teaching were real estate investors. And they weren't the good real estate investors. They were the flippers, right? Those that were gambling on appreciation. They didn't have money. Our business started to go south. I went from millionaire to upside down millionaire. I was in the hole, 15,000, 16,000 a month to the point where I was over $1 million in debt. And I didn't file for bankruptcy.
That made you a millionaire because you owed $1 million, right?
Yeah,
Okay, go ahead.
that's why. I mean, yeah, it was a point where, as I kind of joke, the homeless guy on the street was $1 million richer than I was, because I eventually sold off everything I possibly had, and nothing, So so I was in a pretty rough place. But as that's the cool thing, is that I don't believe that there's ever accidents. I believe that everything happens for a reason. So I stopped teaching people how to get out of the rat race. I stopped teaching about passive income because I was in the rat race, and I can't teach something I don't do. That's why I left being a financial advisor, right? Well, as I did that, I started teaching people how to do what I was doing, which is getting resourceful, how to find money, how to free up cash.
Okay.
And so I started teaching that instead. I pivoted. And after I made that pivot, what happened is that people actually wanted it. They said, I would love to pay you, but I can't find the money.
Yeah.
And in the back of my head, I'm thinking, I'm more broke than you are. If I had your situation, I'd be grateful. And so I tell them, well, if I can help you find the money, would you pay me? They said yes. And that all of a sudden kind of reinvigorated our business to the point where we skyrocketed. That helped me pay off a bunch of that debt, and helped benefit a lot of people's lives. Well, long story short, as I'm out for a jog one day, I'm trying to think of a new business. I could tell that I was going to do my own thing. And I wasn't sure what to call it. I was trying to come up with cash flow something, And then finally I thought, well, let's go to my vision. And the vision was like the people's lives that benefited, hundreds of people's lives already to that point. And I thought about like this one couple in South Dakota. Specifically, he was working as a chiropractor. We freed up $6,000 a month by helping him refinance and consolidate some loans and free up on taxes and stuff. $6,000 a month. He went from working 5-6 days a week down to 4.5 days a week. And the first thing he did with that $6,000 is he bought a 4-wheeler, which of course, if you had a guy like Dave Ramsey, he's going to say, well, you're an idiot. You're dumb. You're stupid. Right. Is what Dave would say. But his wife said, you don't understand. That's the best investment we could ever made, because he's now given himself permission to take the weekends off instead of being exhausted by the time he hits the weekend.
Good point.
So now he's going forward with the kids. He's spending time with us. We're a family again. Like, I got my husband back and my kids got their father back.
That's awesome. You know what? You're 100% right about that. No, and she's right. Yeah, that's a great story. I love that.
And that's the ripple effect I'm here to create. That's where the name Money Ripples came in. Right when I thought of that and what they had said, Money Ripples popped in my head, and that's the ripple effect I'm here to create. Is freedom and prosperity.
So what are you doing now? You're actually helping people raise money for other real estate deals? Is that what you're?
Well, helping them find the cash, and then 2, figure out where to put that cash to be able to do it. We're not investment advisors, but we do have a network of people that, in the real estate space, whether it's turnkey rentals where you don't have to be, you could be hands off in the rentals. Somebody else manages the property. It could be apartments, self-storage. It could be oil and gas. It could be franchises or businesses like car washes. It could be raw land. It could be funds, not like REITs, not real estate investment trusts, but like actual funds where they are like debt funds where you loan the money to investors and they pay you a return.
Which is exactly what Pacific Private Money, that's the company I raise money for, is Pacific Private Money. And that's exactly what we do. We have debt funds. With this chiropractor, now in his case, you were almost like a business consultant though, right? Because you were kind of looking at advising him, hey, if you refinance this, pay off this. Well, so you were finding money within his own organization versus going out and saying, hey, I got a guy who will invest in your company, which is completely different.
Exactly. That's the sexy part, right? That's the offense, but you gotta have a defense too. I was actually sharing a story with one of my other clients recently where this couple, they had $5 million in Apple, Microsoft, Google. This is stuff that they should be not in, especially with that big, heavy of positions, right? For just those kind of companies. But they said, yeah, we want to go and invest it and see if we can create passive income from this. Okay. But before we got started, we said, well, listen, we can actually do some things here in your finances. From what we can see, you could look at the whole picture, including their income and expenses, their balance sheet. Yeah. We're like, we could free up $3,800 a month, which brought their financial independence number down from $22,000 a month down to like $18,000 a month. Sure. Which just makes it more attainable to get to.
Exactly.
And without changing their lifestyle, of course. And then, of course, then we can invest all the other cash and they can actually get out of, get financially independent faster as a result.
Excellent. All right. I like that. That's really good. Believe it or not, another break's coming up.
I believe it.
It goes very, very fast. Well, this is good stuff. It's fun to talk to you. Okay. Third trivia question here. What hockey team jersey does Cameron wear in the movie Ferris Bueller's Day Off? And in fact, it's interesting because if you watch the HBO series Succession, he's the oldest brother, Connor. And it's funny because I was watching it and I'm going, oh my, wait a minute, that's the same guy. That's Cameron in Ferris Bueller's Day Off. And I don't know whatever other thing I've seen him in. But here's the trivia question is, what was the hockey team jersey that he would wear? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Stay with us. The Best of Investing will be right back. Don't touch that dial. Welcome back to the Best of Investing. Edward Brown here along with Chris Miles. Let's see, third trivia question. What hockey team jersey does Cameron wear in the movie Ferris Bueller's Day Off?
That's one of my favorites. I see it. I think it's like an Indian on it. But the only name that's coming to my head is Winterhawks. But I know that's Portland Winterhawks. That's a B League team. That's not.
Yeah, no. But you're kind of close with the what you were thinking. The Detroit Red Wings.
Detroit. Oh,
yeah,
that's what it is.
Because you're.
That's right. It's like the wing with the.
Yeah, exactly. Yeah.
Yep.
I can see.
I was seeing the Indian in my head instead.
Yeah. I get that. Okay. So now, Chris, for your services, what do you charge your clients?
Yeah, for those that qualify to work with us, and usually have to have at least 150,000 of cash they can use to invest in these kind of alternative investments. It's anywhere from like 7,500 to 15 grand, just depending on their situation. The big thing to pre-qualify is we have to make sure that they make more in the next year than what they pay us, and so that's why we want them to have at least 150,000. Because if you earn 10% on 150,000, that's 15,000 a year, right? So that's kind of our big prerequisite.
And that's a one-time fee, but then there's
like a few $100 a month retainer afterwards. They want to keep us on board, stay up to speed. Who's in our network, because that's the thing. We work as strategists and connectors. We're not investment advisors. Yeah. So we're more strategizing the plan, figuring out where the money is, where can you use that money, where are some of the best places, and then we have a network of vetted professionals, not guaranteed, of course, but people that we've vetted that have been in the industry for at least 10, 15 plus years, where they've cut their teeth by going through multiple recessions and know what they're doing. And so those are the kind of people we look for in the real estate game.
Well, what's really interesting about that is, from your clients who pay the 7,500, because you're not charging, you're not getting paid from the sponsor, you are completely independent. So it's like, there's no, you're really trying to do what's best for your client. How do people get a hold of you if they are interested in your services?
The easiest way is just go to moneyripples.com and you can contact us through the website there.
Okay. Well, along that line, I'm not trying to pitch you, but I do want to talk about Pacific Private Money because they're one of the sponsors of the show. So at Pacific Private Money, we will probably do close to $1 billion, maybe $750 million this year in loans. So we have our loan origination, which is basically we're just like a bank, but we can work a lot faster than a bank. So we're able to charge higher rates. And there's a liquidity provision. We ask for at least 30 days notice, but now we're probably around 60 days to 90 days for liquidity, which is still pretty good. You don't have to, there's no lockup period, and depending upon how much people invest, they're getting either 7, 8, or 9%. And it's very short-term loans, very conservative. We have another fund that actually I'm one of the managers of called the Southwest Note Fund. It's probably our most conservative fund because we're buying discounted mortgages that are already in existence. And the interesting thing is the fund, it's a fairly small fund, it's less than $6 million, is the fact that, and I'll bet, because you're familiar with funds, okay? I'll bet, tell me if you know of any one that's as conservative as this, and be honest, okay? Our average loan to value in the fund is 41%, but we're buying these notes at a discount. So our average ITV, investment to value, is 29%. Now, I personally, and I've been in this business for 40 years, I don't know of any fund that is out there that is that low loan to value, that conservative. And that one, we're paying just a flat 8.5% to the clients. And the reason we can pay that is because we're buying notes at a discount. So if we buy a note that's at a 5% yield, but we're buying a discount, we can afford to pay that. Same thing, there's no lockup. And, clients were asking, for 30 days notice, it might be 60 days before they get their money, but at least they don't have to lock it up for a year. So for more information on that, pacificprivatemoney.com. Look at either the Southwest Fund or the Freedom Fund. Let's see, the company's been around since 2008. The first fund started in 2013. No clients ever lost principal. And so even though the market has had its ups and downs in real estate, it's just, I guess it's because we're doing short-term loans. So we're out of these loans even before the market has a chance to really dip down in value. But we did loans as a company 2008, 9, 10, and 11, and the market was still going down, but nobody lost money because now maybe the owner of the property maybe lost money because he put down, on $1 million property, he put down, 300,000 or 400,000, and we lent him 600,000, and he sold it for 800,000. Well, we got all our money back plus interest. He maybe lost money, but as the lender, we don't like to lose money. So we try to be pretty conservative on that. So again, go to pacificprivatemoney.com. So give me some stories of how you've, you did give me the story about the chiropractor, and you were talking about the wealthy family who had millions of dollars worth of stock, and you're able to kind of free up some there. What other kinds of companies like do you suggest that people look at? Because alternative investments are kind of interesting, because most of them you have to tie your money up, most of them, and with the mutual funds, market goes up, market goes down, the whole thing. I just don't like losing principal. I'll be willing to accept a little bit of a lower interest rate. Of course, we're paying 7 to 9%. That's a pretty good interest rate, but for the most part, as long as you don't lose principal, not bad.
I agree. No, return of your money is more important than return on your money. It's kind of our mantra that we say, because you want to make sure you get that principal back. I mean, the interest is great and you want that, but it's so important to get that money back. I was just talking with a guy today where he had a guy he invested with, a friend of his for a while, and he'd been doing in the space for a while, but he built the company too big, too fast.
Yeah.
And all of a sudden now he's going through bankruptcy, with the company, and he's on properties, fortunately. But of course, like any bank, you never want to be on the property where you have to assume it and take over ownership again. And now he's realized some of these properties are hole-in-the-wall Ohio properties, St. Louis, things like that.
Yeah. I mean, it's interesting because depending upon, again, where the property is, what kind of property, how much you're into it for, potentially you can do really well if you have to foreclose. But on the flip side, if there's some properties that are like, what, what are we doing here? That's not going to be so good. We've got like another minute before we go to a break. What else do you want to cover here?
Yeah, I'll kind of share an example of the contrast between what we see in traditional advising versus what we talk about. Because we had one client that had $1 million, and his financial advisor said, well, 3%, you can live on $30,000 a year. He said no. Instead, he went and he got some ownership in an apartment building. He did a few turnkey rentals. He even got into some funds as well, and even oil and gas. And when all was said and done, it was deployed. It was about $11,000 a month that was coming in. So versus $30,000 a year, he was now making $130,000 a year. Some of it with tax advantages, right?
Yeah.
And that's the big thing, is that it's all about the income, the passive income, the cash flow. That's what's really important.
As Mr. Wonderful says on Shark Tank, cash flow. He likes that. All right.
That's right.
Stay with us. The Best of Investing will be right back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Chris Miles. So we didn't have a trivia question for this segment, but so Chris, it's kind of interesting. We were talking off the air just before we came back about what kind of assets that you like, and what I find interesting is we've actually had a lot of clients invest in our Pacific Private Money funds because of the fact that there's fairly decent liquidity. They use it as a parking place until they find their next real estate deal or their next stock they want to buy or their next car, house, whatever. What other, where else can you get anywhere from 7 to 9% fairly conservatively until you get your next deal? Because we always tell people, so you're not going to get rich off of us. We're not that kind of fund. You're not going to make 20, 30% like you may or may not make in the, stock market or some other real estate fund. All we are is we're just a bank. We're just a conservative little bank. I mean, I use that term, we're not legally a bank, but we're like a bank because we make mortgages and secure it with the real estate. But what other kinds of assets do you like?
I'll tell you this, the biggest lesson I've learned over the years is do the opposite of what everybody else tells you, right? When everybody's telling you buy stocks, don't buy stocks. They say buy crypto. That's the time to sell your crypto, right? Same thing with real estate too. And here's what's interesting. I learned this in 2022 when I started hearing everybody say, I don't want to lose inflation, invest every dollar. And
Yeah.
as a result, I said, don't invest every dollar or be liquid with your money.
Yeah.
I
Yeah.
even started telling people, get lean, get liquid, and get out.
Yeah.
Well, with you're talking about your fund where you have that liquidity option and you still make 7 to 9%,
Yeah.
that's huge. That's a
Yeah.
big benefit. And I've had more and more clients going that direction
Okay.
where they want to have some options because they think, well, you know what, there might be a bigger recession. There could be more
Exactly.
opportunities down the road.
That's
But
right.
I don't want to tie it up for 5 years in a deal. Even if
Exactly.
the deal pays me well, what if
Yeah.
there's a better deal? And so
Correct.
they're looking for a temporary place to put their money. And so funds have been a big one. If they are willing to lock up money, things like rentals, if they've
Yeah.
got strong cash flow, which very few have, but I
Yeah.
do like having actual assets like in play.
Yep.
That's good too. Oil and gas has been a great one. That's probably been the most popular for our clients lately, is just because really, I mean, you can make money off the rent of the land to the oil companies, and then also make money on the mineral rights, the royalties that you get paid on
Yeah.
as well. You kind of double dip.
Yeah. Yeah. How do you vet the oil and gas? Because I remember, like, probably before you got in the business, when I used to do financial consulting, even before I was actually in it, oil prices had just plummeted.
Mhm.
Texas was not doing very well. And a lot of Petro Lewis is the one I'm thinking of. That was a really big one. And a lot of people got smoked on it. But I know things are a little different now. And a lot of funds are a lot more conservative in how they structure their deal. They don't take, 20, 25% off the top for their fees,
Mhm.
and leverage it up to the hilt. That's the other thing, is that leverage will just kill you,
Yeah.
because like us, we're the bank. Our leverage will kill you. I mean, really, you
Mhm.
don't pay us, we're going to foreclose and we get all the money. We're going to take it. So we're willing to give up the profits to you, the investor. But sometimes things don't work out exactly well. But with oil and gas, yeah, I guess if you own the land and you're just leasing it to the oil companies, again, who knows what's going on with the green energy and all that, and you still, I don't think these people understand. You're still going to need oil, even for the green
Yeah.
energy. You're going to still need oil. Where else are you going
Even
to
the
plug
Biden
your?
administration found that out. They looked at the most
Yeah,
conservative, like if people went more to electric cars and things like that,
yeah,
they said that by 2050, at most 10% of people will be driving electric. 10%.
yeah.
And oil consumption will go up. So
Unless they're gonna, that's, what, they should kind of look back at doing nuclear. Everyone gets
Mhm.
scared, oh, nuclear and meltdown and stuff, but when you look at it, it's the same thing. It's like, oh my gosh, don't fly in an airplane, it's too dangerous. Everybody could die. Well, we know that, but you look at the risk and how often do people die in an airplane? Not so much, right? Well,
that's
Chris,
right.
I tell you, it's been a pleasure having you on from Money Ripples. Really appreciate it. You can check out moneyripples.com and get in touch with Chris. You ready? Here's our thoughts for the day. Did you hear about the kidnapping at school? It's okay. He woke up. And did you hear about the two people who stole a calendar? They each got 6 months. All right. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.